Welcome back to the deliberations of the Citizens Monetary Policy Committee of CNBC-TV18. Our members have voted for a 35 basis rate hike on December 7th, but the stance becomes important because we want to know how many more hikes are in store. Sonal, let me start that with you. Well, I must tell you that our members are Shravika Ghosh, Sajid Chenoy, Samiran Chakraborty, Sonal Verma, and our chairman, Dr. Pranab Sen. Sonal, what's your sense about how the RBI may go about its stance? As Dr. Sen pointed out, there seems to be a lot of uncertainty. So how should they word the stance?
Sure, Lata. So I think it is, given the uncertainty, it is too soon to signal a pause at this stage. But I think acknowledging the changes is also important. So I think while retaining the withdrawal of accommodation stance, certain tweaks are necessary. This in the statement. This could be adding the cumulative effects of policy tightening already delivered or the lags of monetary policy while retaining a withdrawal of accommodation stance. So this inherently does not signal a pause, but does signal that we are getting closer to a point of neutral. So I think some tweaks are essential to the stance this time.
Okay. But what about liquidity? Ultimately, when you say withdrawal of accommodation, we were thinking of it in terms of liquidity. Soumya, isn't the liquidity withdrawn enough, or can they continue to say that there is a lot of durable liquidity?
No, I think, Lata, it's an interesting take over here because things have suddenly changed in the month of November if you look at the liquidity data. When in April, the core liquidity system was around 3.6 trillion. In September, when the RBI made, it was around 8.3 trillion. Okay. In September, it was around 3.6 trillion. And today, the core liquidity is 2.7 trillion with government cash balances now very close to 1 trillion. So, which is a significant climb down from 3.5 to 4 trillion earlier. So, technically speaking, if the liquidity is close to, zero or within the tolerable limits, the RBI should actually take it to neutral. But the point over here is that if it does signal a change in stance today, given the uncertainties in the global economy and given the fact that Fed is actually going to take it longer for longer, I think that change in stance could confuse the market because neutral means you are also in a position to go the other way. And finally, the point is that I think the capital inflows have been very strong and with this stance also, and if it continues to remain strong, that will also give the RBI a chance to recoup the forex reserves, which is possible it is currently doing. So in my sense, keep the stance as it is, but maybe a little change, withdrawal of accommodation stance remains same, but maybe a word on the global uncertainties about the Fed rates and other things.
No, I wanted to know whether they have to signal that they have to give liquidity, because what is 2.72 trillion? It doesn't mean much because there will be cash withdrawal. So Samiran, will the RBI have to say something, at least in the press conference, about even giving liquidity at as early as next year?
I think next year is still some way off. At this moment, I think the way RBI has framed this right now, there are two different elements. One is on the liquidity side, the other is on the real rate side.
Yes.
And on liquidity, the durable liquidity is still more than 1% of GDP, which compared to pre-COVID levels is still quite a bit in surplus. So there is this way of RBI saying that they need to reduce this even further. And on real rates, now it's different people have different definitions of real rate, etc. So there it's slightly more complicated for them to say that whether they want to have a higher real rate than what is anticipated in the market now. But still, if you put both the things together, there is a higher probability that they will have to repeat the phrase of withdrawal of accommodation. And obviously, there will be some bells and whistles around it on the lagged impact of monetary policy, etc., etc. But the overall stance, I think, still has to be withdrawal of accommodation only.
Okay, let me get away from the stance. I'm trying to get you all to tell me about the peak rate. Whether the Reserve Bank goes all the way to 6.5, 6.75 or stops at 6.25. Now, Sajid, then the real rate becomes important.
Yes.
A real rate, for those who don't care too much for jargon, is the nominal rate, the rate which we pay for borrowing money, minus inflation, which is the positive real rate. At the moment, it is negative because inflation, until recently, was higher, the current inflation, actually even today. But if you look at forward inflation, the Reserve Bank is expecting 5.2. So at 5.9, we are 70 basis positive real rate. The governors seemed to hint last time that before the cycle turned and we went into accommodation, the real rate was over 2%.
Exactly.
So do you think the RBI needs to hike as much because we need at least a real rate of 1.5? What would your thoughts be?
So Lata, a couple of things. You phrased it exactly right. When we talk about withdrawal of accommodation, let's not get too obsessed about liquidity. Even the real rates are today, compared to historical levels, very accommodative. If you get a 35 basis point hike at 625 and the RBI's forward inflation holds true, you're at a real rate of 1%. Pre-pandemic, as you said, they turned from tightening to neutral at over 2%. The fact, however, is that in the last 3 years, like in the last 10 years, there's a perception that neutral rates have come down over time. So we can't mechanically go back to the pre-pandemic level. The short fact is we don't know what the terminal rate is going to be. There are two-sided risks in the world. There are two-sided risks in India. The fact is when global growth slows, it'll have an impact on India. And simultaneously, however, core inflation has been very sticky above 6%. So what the RBI needs to do is buy itself some optionality. Having done 350 basis point hikes, it can now afford to step down, but step down in a manner that doesn't stamp its own previous transmission. Remember when Powell stepped down in September, wanted to step down, he was very hawkish. So I think the stance has to buy some optionality so that if the slowdown and disinflation dominates, you can even stop early next year. And if the Fed becomes more hawkish and core inflation remains sticky, you can keep going. The key will be step down in rates, but your stance should be open enough that you have two-sided optionality.
Much like what Dr. Sen said, keep your options open. But Dr. Sen, what's your sense about how much should the positive real rate be? Do you think that, there is deposit rates as it is are not rising. There are more people investing in stock markets than in bank deposits. As well, you are seeing a lot of rural inflation in pain. A lot of FMCG companies are speaking about that. So inflation is clearly taking away purchasing power. Do you think, therefore, the RBI needs to go a little more aggressive, go all the way to 6.5 or something, and indicate that positive real rate in some fashion?
No, Lata.
No.
That would be bad policy. I completely agree with what Sajid said, that we are in a situation where we really have to rethink what is the stable real repo rate, not the bank rates, but the repo rate. That's a signaling device. And, we have unfortunately too often confused the repo rate with whatever are the deposit rates in the banks. That's a bad way of looking at it.
Okay.
As far as the repo rate is concerned, I think we are in a situation as a country where if the repo rate is 50 basis points in the positive territory, I think we should be okay. All of this 150 basis points above, I think, is old hat. We shouldn't be going targeting that at all. Now, if you take that as a given, then we are in a situation where with a 35 basis point hike, if we go to 6.25, then we are going to be in the territory that we want the repo to be in. We may need to tweak it back and forth. So I would say withdraw the accommodation, but as far as the stance on the rate is concerned, just move to neutral. Tell people we are willing to jump either way depending upon what is happening globally.
Okay. Fair point, sir. I think we will get a better idea of what you all have in your mind in terms of rates and stance if we take the vote. So let me first take the vote on the stance. The current MPC stance is withdrawal of accommodation. The stance is we are withdrawing accommodation. Will they change, Soumya?
No, I think they will keep it as withdrawal of accommodation, maybe with a little tweaks around the statement.
Sajid?
Withdrawal of accommodation with some tweaks to give the two-sided optionality.
So no change, no change. Samiran?
No change, not too much.
Okay. Sonal?
Withdrawal of accommodation, but with the tweaks I mentioned earlier.
Okay. Dr. Sen?
withdrawal of accommodation with a hint towards neutral.
With a hint towards neutral. Okay, so practically everyone is, asking for one step out of withdrawal of accommodation, but not completely. Okay, but the important point is, what will the next peak rate be? Again, what are your guesses at the moment?
At this point of time, we are looking at a terminal rate of 6.25%.
6.25?
Hard to say, but between 6.25 and 6.5.
No, give me one rate. 6.25.
6.25 for now.
Okay. Saviran?
I think we'll need an insurance hike of 25 basis point, taking it to 6.5 after this
6.5.
policy.
Sonal?
Lata, we have 6.5 as the terminal rate in our forecast.
Okay. Dr. Singh, genuinely your casting vote is needed.
Well, I go with 6.25.
Okay. Well, thank you very much, members of the Monetary Policy Committee and the chairman. On the peak rate, there is a divided house here, and they're veering towards 6.25, which will be, of course, music to the ears of the market. But the important part is everyone believes that you can jump either ways. This monetary policy may actually indicate that the Reserve Bank will not and has not made up its mind as to what it will do in 2023. That's it from this very special deliberations of the Citizens Monetary Policy Committee. Thank you for watching.